actually over the last 18 months, it's been pretty stable. So it's not moving up or down, the buy now, pay later option. Then when it comes to pricing, I think we adjusted kind of our value equation a few years back, and we've held that. Of course, that has two components. One is to kind of create the brand desire, which to the previous question, innovation plays a role, but also the general experience that we offer in our stores. We keep investing in our physical network as well as the kind of e-commerce business. And the other side, of course, is the pricing components. I think what I've seen over the last 4 years that I've been here is that we managed to kind of fix the pricing. That was the first step, and now we're kind of putting more and more energy into the desire piece on the top end of that equation.
US sees an improvement to -4% on the like-for-like basis as well. I see a lot of stress in the United States, I've got to be honest as well. The consumers just being very discerning now as well. Do you think those like-for-like improvements to the -4%, do you think that's as good as it's going to get, or do you expect to get into positive territory?
Well, I mean, I think for the US specifically, if we land the year around flattish, then I think we will be very, very happy, because as I mentioned, this market is trailing in the negative, which again then would suggest that we actually take quite a bit of market share.
Alexander, can I ask you about the cost side? What are you seeing at this point in terms of raw materials and also on the labor side?
So if we start with the labor, of course, because of what we've seen in the last, let's say, 12 to 18 months, the salaries in this year's cycle has been a little bit higher, so that has a slight effect on the bottom line. When it comes to raw, the main raw material we use is silver, and we hedge this 12 months out. And the silver price has been kind of hovering between, let's call it $22 and $25 per ounce. So actually, it's kind of over time, this is not a major impact, and this puts and takes as we go through, as the hedges come in and out. So not a major equation for us.
Yeah, and I like the way you've put it. We're talking about costs there with Karen as well, about democratizing diamonds as well. My understanding is that a lab-grown diamond costs between 50 to 70% less than a naturally mined diamond as well. You call it democratizing diamonds as well. I guess the obvious question is, does the customer care?
It depends on which customer we're talking about. So when we enter the diamond market, we're not trying to let's say, appeal to that very high-end customer. And those are typically the people that have been buying diamonds in the past. We're trying to, as we say, democratize it. So we're opening up this space for people that in the past maybe wanted to get into this market but simply couldn't afford it. So we offer a very attractive design, a very interesting brand narrative around it at a very good value equation. So yes, of course it plays into the whole thing.
Alexander, I want to ask you about one of our big stories today, and that is around China. We've just had retail sales numbers, again, indicating that there's softness in the China market. You've been cautious there all year. You slowed down the planned relaunch of the brand in China because of some of the weakness earlier this year. What exactly is playing out when it comes to the stores in China?
So we just started our kind of brand relaunch in China a few weeks ago. So it's too early to report anything, significant. We've seen a little bit of a pickup, but the way I think about it, this is a long-term play, and in a long-term game, there will be puts and takes in the market. We all go through cycles. So of course, in an up market, you grow a little bit faster. In a down market, it slows. I mean, this goes without saying, but it doesn't change my mindset of we're going to kind of build the brand in China, and this will take time, whether or not there's a positive or negative cycle ahead of us.